Welcome back to another episode of Drilling Deeper. I'm Kevin Yannick, Editor-in-Chief of Pit and Quarry. We're going to talk state of the industry today. And with me, I've got our fearless managing editor, Jack Kapansky. Jack, how's it going today?
Oh, I'm full of fear, actually, Kevin, but I'm glad to be here. Excited for another good episode. How are you doing?
Doing great. I'm looking forward to talking about how construction materials is faring right now. We brought George Reddin and Rob Mineo in recently to talk about M&A, about different markets, and we're going to cover a lot of ground during today's interview. But first, let's get a word from our sponsors today.
Our wonderful, wonderful sponsors. That's right. Thank you first to the sponsor of our show, TCI Manufacturing. Celebrating 25 years of excellence in 2025, TCI Manufacturing embodies the promise of concepts to reality as the industry's leading aggregate resource. TCI specializes in precision-engineered, custom-fabricated steel products committed to delivering top quality, strength, and precision in every project. Learn more at www.tcimfg.com. Thank you also to the sponsor of this episode, Syntron Material Handling. With more than 140 years of bulk material handling experience, Syntron Material Handling is a recognized industry leader that provides innovative engineering solutions, high-performance products, and superior customer service. Syntron offers solutions in conveying, feeding, screening, elevating, vibratory flow aids, and mining controls of bulk product. For more information, visit syntronmh.com. Thank you to TCI and Syntron.
Yeah, thanks to those sponsors. And as I mentioned at the top, we've got an interview on deck here with our friends at FMI Capital Advisors. Those guys would, again, be George Reddin and Rob Mineo. They're managing directors with the firm based out of North Carolina. And anyone who's been to a Pit and Quarry Roundtable and conference in the past has probably heard George speak. I think he's delivered a construction materials market outlook at every roundtable in my career. And he and Rob, along with Evan Coughlin at FMI Capital Advisors, write for the magazine once a quarter, kind of talking about what's happened in the previous period. And our interview today kind of dovetails into what we typically put out in the magazine with those guys. We talk about mergers and acquisitions quite a bit and how healthy or not healthy that market is. Here in 2024, we talk about what's happening with construction materials, getting into the non-residential, the residential, and the non-building market, talking about infrastructure. And we also talk about some of the dynamics that are around construction materials right now, like what's trending with volumes, with pricing, with some of those dynamics, because it's been changing and evolving over the last several years, I guess. For the most part, it's the good times continue to roll, Jack. But George and Rob, as always, they offer a really good breakdown on where things are at this point in time, and I'm looking forward to sharing and relaying some of the insights they provided to us here to listeners today.
Yeah, they've absolutely been a great, FMI's been a great company to work with for Pit and Quarry, and I've gotten to know George and Rob pretty well over my now 3 years here with Pit and Quarry, and obviously you've gotten to know him during your time as well. And you mentioned George's presentation he does at the roundtable. I feel like that's the most requested thing every year. Whenever George does his presentation, we've got people, immediately after the presentation up to like weeks after asking if they can get a copy of George's presentation, because the guy is just so on top of it, so on top of what trends are going on and what's happening. And obviously with Rob and Evan at his side as well, it's a pretty dynamic trio, if you will. And I think one of the great things about George and Rob is they obviously have a very good pulse on the industry, and they're not afraid to kind of say, like, there are some sore spots, but there's plenty of, at least in this case, as you'll hear in this interview, there's a lot of positives, there's a lot of good stuff going on. We did this interview around the time the second quarter reports were coming out from the major aggregate producers, and one of the things you'll hear in the interview is them talking about the impact weather had in the second quarter, which is something that seemed to carry over from the first quarter as well. And as we were putting together those second quarter reports, that's the same thing you hear from the Vulcans, the CRHs, the Martin Mariettas, where weather was such a huge factor in the second quarter. And Rob brings up an interesting point that you hear, that it's not only unseasonably wet weather, but it's also the heat of this summer, where a lot of places are getting hit with some high temps, some record temps in some places. So he'll kind of dive a little bit into that, into the impact that's having. But as always, just a lot of great insight from these guys, and I'm sure you're going to enjoy what they have to say.
Without further ado, let's hear from George Reddin and Rob Mineo of FMI Capital Advisors.
We're here at about mid-year, toward the end of July, and I'm sitting here at my desk and kind of awaiting in the coming days some of these second quarter reports coming out that are going to give us a lot of intelligence on where construction materials firms are at this point in time. And I know Cemex is coming across, and I think Eagle Materials is another one that I'm expecting this week. So we don't have the full data, I suppose, at our disposal. But what are you guys seeing here as we're, in the July, August, mid-year period? How has the construction materials market fared year to date here in 2024? And I guess what may be to come as we're expecting these reports related to the second quarter here shortly.
Yeah, Kevin, I think when we ask about how are we doing or comparing things, you compare it to what? 23 was a pretty impressive year for the sector, right? Demand was great, backlogs were strong, and they got a lot of pricing in 23, and that dropped to the bottom line. So earnings, EBITDA, was very impressive. What we've seen the last 2 or 3 quarters is a tempering of the ability to increase prices. A little softening in units, in tons, but earnings are still increasing. So it's really at a very healthy level. It's just if you're comparing it to 23, it's going to look like it's softening, but it's really at a very high level.
You guys, anything to add there, Rob?
Yeah, I'd say that just to emphasize what you said, a lot of what we're reporting on is what people being told us and such. We still got the USGS Q2 results coming out soon, and the CMIs are going to report. Companies in the CMI are going to report the public results pretty soon. So we'll see if the numbers match the sentiment. But I think in sentiment terms, I agree with what George says.
What are you guys seeing in the various construction markets right now? I mean, it seems like total construction spending is in a pretty good space, and it's projected to be that way for a while here. But as you look at non-building, that being roads, bridges, and highways, and then some of the maybe smaller drivers or lesser drivers, non-residential and residential, what's happening there? I mean, we've seen some ups and downs in those last couple here over the last couple of years. I guess what's driving, what's tapering, and where are things at in those segments, guys?
Yeah, so we'll always caveat that construction is local. So we talk national trends. You have to be very careful because different markets have different drivers. But from a national standpoint, FMI just released its newest quarterly update. And I'll speak in dollars in terms of what we're seeing trend-wise, not units. But for non-building, it's always slow and steady wins the race, and a lot of people love investing in that space. We're predicting about growth about 8% this year over last, which is about the same. Doesn't sound slow and steady, but it's had that big boost from the IIJA, which is kind of pushing things forward, and we expect that to continue. For residential, we actually are predicting an increase of spending, but that's coming off a previous decline. So any increase is a pretty big jump, seeing that's where we were before. But remember, that's by dollars, not by volumes or starts. For ags producers, we're going to be monitoring units a lot more as the USGS reports come out for growth. But any increase is a good increase, and if we're seeing it for dollars, that's good overall. And then for non-residential, that one's a little tricky because it's a catch-all, right? It includes a lot of different items get thrown in that bucket. Recently, we've seen a huge growth in manufacturing and distribution, which, there was like a 50% increase in dollars spent last year over the previous year. So this year you might see a slowdown, but a slowdown of enormous growth. Anything that's not a decline is good. But again, construction's local and it depends on what your portfolio looks like. So if you're a producer feeding into manufacturing, you're probably feeling great. If you're feeding into like lodging or education right now, you might be a little less optimistic. But overall, I'd say all the trends are strong and doing well.
Rob, does the road ahead look healthy for manufacturing? It's kind of funny looking over the last several years. Like you said, non-residential is kind of fueled by like one or two things. It was warehouses and data centers at one point really kind of driving that forward. And, now it sounds like manufacturing is really the leader in the clubhouse there. Does the road ahead look pretty healthy relatively for non-residential, again, because of manufacturing?
I wouldn't count anything out. I would say, honestly, that every time some sector slows down in this new e-commerce economy, something else builds up. Right now, cold storage refrigeration is one of the highest growth markets for private equity investment, which no one really thought of, would be 20 years ago. There's so much in changing of how we buy things that needs so much logistics and infrastructure, manufacturing with the focus, but also distribution, also storage, things like that. And with AI being so big and the new servers having to be built, I think that we are still very bullish on that whole sector. It's just going to be different spikes amongst kind of a jump together grouping.
Yeah, Kevin, this is another one where you got to be careful with the percentage increases. Manufacturing has tripled in the last 3 years, right? 80 something billion to 240 something billion, right? So if we now moderate the growth, but on a base of 240 versus where 3 years ago it was just 80, still very impressive. So I wouldn't get hung up on the percent growth on some of these markets. It's as that bubble for the size of that market continues to increase, more modest growth rate yields a lot of activity.
Rob, I think it was you who touched on, where volumes are at this point. And, I think we've seen for several quarters in a row, including the first and fourth quarter of 23, I guess, going back that far, that volumes continue to tick downward a little bit. I don't know if it's the end of the world, because when you talk to producers out there, they continue to tell us that they're busy, their plants are running. They don't see much slowdown versus 23 versus 22. And again, I guess we were operating on some historical highs there earlier this decade. So, again, you touch on that, the volume decline, those USGS reports. Any cause for concern there with where those are trending?
I wouldn't say cause for concern at all. I do think that volumes need to be spoken about in the same discussion as pricing. And we'll get a little more context there. But with the dollars out there, they go hand in hand. You really have to understand how it's not just one piece of data in a vacuum. You got to look at everything.
Yeah, so Kevin, from the health of these companies, they're looking at things like revenue growth. They're looking at things like profit growth. And that continues to be very healthy, right? So, if we have fixed funding but increase in costs, we're going to end up with fewer units, but the companies are still doing very well financially. And the other thing for year to date, Q1's a tough one to look at. That's the data currently available from USGS, because in many of those markets, it's the slow quarter, especially if you have cold weather or short season markets. So it's kind of difficult to really take a conclusion out of Q1 sometimes.
Let's talk too about pricing. And George, you're saying, you have to kind of look at those as they go hand in hand with each other. Again, another example where we've seen kind of quarter by quarter growth over a stretch here with good pricing momentum for construction materials producers. And, from what we've kind of gathered, it seems like that slowed a little bit, or the momentum there is slowing. It's still there. I guess, how would you characterize the activity you're seeing right now for pricing momentum? And is the end nearing where producers quarterly can continue to expect moderate to small gains in pricing that are going to help those EBITDA figures?
Yeah, so we were tracking this in 23 and seeing data from people who would report it. The public companies, that's where we get our publicly available information of double-digit price increases, the quarter over the prior year. And that's moderating, right? So fair enough. You had inflation raise its ugly head in late 21, and we get hammered in 22 and into 23, and prices increases lag. So they got their nice healthy price increases in 23. And I think we're going to see the data coming from the public companies who will share it with us that price increases are moderating and heading back towards where inflation is.
How about cost? I think we continue to see certain companies in their reports allude to cost management, inflation, as you talk about. I guess, how would you describe the impact that costs are having at this point? I mean, they're obviously increasing their own product prices to a degree. How is that in line with their own costs, as you understand it?
Yeah.
So for costs, I think everyone knows this, but it's nice to kind of level set and remember that when you look at inflation numbers, this is the growth percentage. So if you had large inflation numbers, you had a lot of growth, and then it slows back down to what the Fed targets for inflation, but it's still growth. So it's not like things have gotten cheaper. They were just not growing at the speed they once were. And that's passed on for pricing, but it hits you on cost also. And I'd say where that's the not as shiny news right now is that things are more expensive, and they're not getting less expensive. They're just getting more expensive slower than they were about a year ago. And when that really comes to kind of hit you with something like labor, right? Labor is more expensive than it's ever been. And all these companies are trying to figure out the new operating model, because on top of labor being expensive, there's a vast majority of of people who work in this industry who are looking to probably retire in the next 10 years and not enough people to fill their shoes. So I think the cost side of the equation is going to become more and more of a factor. And it's where a lot of the eyeballs or the people in the know are resting right now.
If I can ask one more question that kind of combines, those three areas, costs, pricing and the trend there, and then volumes. So, I mean, I guess as volumes are coming down, guys, assuming they stay on the, this pace where, single digit drops quarter over quarter and, pricing is moderating, if costs still can't get under control, I mean, what does that do to the environment, I guess, third, fourth quarter, looking into 2025? Does that raise your level of concern when those things are kind of trending away from their peak highs?
Yeah, I think when we think about inflation comes first, prices follow second. There was significant inflation. Construction industry actually had more inflation than when we looked at the consumer price index as a whole. So it was expected that you get these big price increases. And a lot of that drops to the bottom line, and the performance was very good. That's moderating now, which is to be expected as you catch up. But as Rob said, costs are going to continue to go up. Labor is going to be a big challenge for the sector. Attracting people, retaining people, paying them, and our prices will go up commensurate with that. The industry will understand that. But it will just be, I think it'll be a little bit more smooth and a little bit more rational than it's been in the last, say, 18 months.
Guys, let's talk weather too, if there's anything that you want to weigh in on. But I think we saw in the first quarter here, some of the producers alluding that, the weather was a factor. It slowed sales. They had some non-working days. I think you guys mentioned too, the first quarter is probably our slowest producing quarter of the calendar year. So if you're going to have a bad weather quarter, that's the one to have it in. You guys are regularly kind of tracking numbers, I think, from the NOAA, the National Oceanic Atmospheric Administration, something like that.
You good? Yeah.
Yeah. Patch the social studies test. But what are you guys seeing with those numbers, if that's something you've been on top of lately?
Yeah, look, everybody's using that now, that database. It's a free, publicly available database. And it's good, but it's not perfect, as in lots of data analytics. So, for example, you may have a state that will show, per the NOAA database, significant rain compared to prior year or prior quarter. But what we don't know is, when did that rain occur? If it occurred on Saturdays and Sundays when we're not operating, might not be a big deal. If it occurred after 4 p.m., 5 p.m. in the evening, may not be a big deal. If it occurred just for 3 or 4 days and it was just total monsoon, might not be a big deal. If it happened every day at 7 o'clock in the morning, it could be a real big deal. So you got to kind of take a look at it. But I'll give you an example. You said some people have a small quarter. New England, percentage-wise, was way up, but it's only about 5% of their volume for the year. So, it'd be nice to peel back a layer of that onion and find out where that came from. The Northeast Central was a big winner. And you can look at the maps from NOAA, and you can see that it was very wet last period compared to this period. The South, if you looked across, a little wetter, and volumes were down in that sector. So I think it's helpful, but it's not a perfect database to rely on. I think you have to kind of drill down a little further once you get that high level information from NOAA.
And it's also not just rain. I mean, rain is the easy one to track, you'll think about. But, Houston had what I believe was the earliest hurricane in recorded history in a time frame of the year this year. And last month, Reddin, California had the hottest day ever recorded. Those things, California, weather probably includes fires, how I think of it. And then hurricanes may only have a 1-day rainfall effect, but the whole place shuts down for a week. So a lot of different factors there. It's something important to track, but there's a lot of nuance to those points.
George, Rob, let's talk too about FMI's CMI, the Construction Materials Index. I think when I was looking at that just a few months back, you guys reporting how it was really outperforming general indices out there, by a good amount, by good percentages. What was the latest with the CMI, where that's at, and how are construction materials firms comparing at this point in time, here mid-year 24 versus the general market out there?
Yeah, so as of close of business, the market's closing on Friday. We're looking at two ways. We're looking at it the last 12 months, and we're looking at it year to date. All right, for the last 12 months, the CMI index is up 30%. And the Dow, for example, Dow Jones Industrial Average is up 15%. S&P's up 20%. These are good high-level comparisons, but the nuances within the S&P and the Dow, want to be a little careful how we compare these. But the market's doing very well. Year to date, we're up 20%, the construction materials index, and the Dow's up 8%, and the S&P's up 15%. So we're double or more than double the Dow in those two periods. And so the sector's doing very, very well.
Rob, anything to add there on CMI and what you've been seeing the last 7 months or over the last 12?
Yeah. The only thing I would add, and this everyone knows this, is that the Dow and the S&P are burdened by, they get the benefit of diverse industries in them, but they're burdened by that also. And right now you've got the tech stocks like Nvidia or Tesla or taking these giant swings, even Apple and Google, and they cause a lot of volatility just by their mere size. And the CMI, as we have it designed to, benefits from not having that volatility. So you look on a given day, the disparity may not be as important, but I think the point is that trending over a year, the CMI is outperforming by significant amounts both these indices, and I think that's just a very strong sign that the quote unquote smart money still has a lot of faith in the industry.
So in other words, it could say, it does say a lot of good things about construction materials and where that is and where it's trended, but it kind of is an indication of how other firms are performing or their lack of performance of late, because you get some of those, big companies out there, and you talked about volatility. That makes us look a little bit better in some ways, you're arguing?
Yeah, Tesla misses earnings by 45%, the stock plummets, CMI isn't affected by that. So, right. But they're so big, they're going to sling on the other indices.
Sure. Well, M&A, that's obviously one of the services you guys specialize in and offer at your firm. And I don't know that we've seen, mega deals take place in large here in 2024, but, I keep seeing releases come across my desk where it seems like companies are bolting on and looking at platform opportunities, maybe somewhat similar to 2023. Is that a fair assessment? Are you seeing sort of deal-making activity here in 2024 kind of mirror what we saw in 23, or is it a little bit different in terms of its shape and form?
Yeah, that's a great question. And I think rather than comparing, I'll just say that there's a lot of activity right now. Most are companies that we represent selling don't try to game or time the market, but they're certainly going to take advantage if the market is a good opportunity for them. We're 3 years from this 5-year IIJA bill. The buyers are making a lot of money and have a lot of money. The sellers are doing well, but also have good visibility in the future. So if you're contemplating an exit, this is a great time to do it. And we're seeing a lot of people take that route. I'd say that from a buyer's perspective, if you got $1 to spend, you're probably more likely to focus on the asphalt, aggregates, infrastructure side of the equation right now than the housing side, which is more of my ready mix concrete, just because we have this IIJA bill. And we keep hearing that interest rates are going to fall for housing, but they haven't really done that yet, which means that, it's a little bit of a hazier outlook, a little more risk if you're thinking about where you're going to build and thus put your money. But my expectation would be once we see the IIJA start to roll towards this latter years and interest rates do start coming down, it's just a pendulum, and that swing will move towards the other side. Overall, the industry is healthy on both sides. I'd say it's just, if I have $1 to spend, I'm probably leaning towards the infrastructure side right now.
Mm-hmm. George, how about you? What have you seen?
Yeah, early last year was pretty soft globally, right? We could saw the statistics coming in, and then it really ramped up in the second part of the year, and it's continued on through the first 6 months or 7 months of this year. There's some uncertainty out there, macroeconomic wise. Did we have inflation under control? Are we going to see interest rate decreases? And it was still fuzzy early in the year last year, and it's clearing up some. And people are now talking about not if, but when the next interest rate decrease is. People aren't talking about the recession term. They're talking about modest GDP, which is somewhat in the plans to tame inflation. So I think that the buyers are super well prepared for M&A, especially when we look at the health of the public companies. Their balance sheets are really strong. We would say we see that with our private companies as well. So the buyers are there. They're equipped to buy. They've got access to capital. And sellers tend not to do this to purely time a market. They tend to be privately owned or influenced companies for the most part. And it's usually about a generational transition or succession planning dynamic. And right now there's a very healthy supply of sellers and a very healthy supply of buyers, and that's really good for the M&A business.
Might we see the nature of deal making change, in 2025 and beyond? Rob, you mentioned right now it's kind of more heavy on the aggregates and the asphalt side. Does that mean that there's more possibly to come as you look downstream in construction materials?
Yeah, I mean, I think aggregates are always in favor because the barriers to entry, it's just it's a safer bet in general, which is great for your readers. I'd say that, not to dodge the question, but unfortunately, it's got to go back to that construction is local piece, because if you're in Texas where they don't build houses, they build cities, they build these giant expansions. I'd say that there's going to be, once these interest rates drop, the population growth is there. They're going to kind of green light a lot more of those. There's going to be a lot of opportunity there. But if you're sitting in a part of the country that, needs a ton of updates on its infrastructure and the dollars are there both from a federal and county place, I think that's still going to be a place that people focus, and it's going to be attractive. So again, not to skirt the question, but I think it really depends on your local portfolio.
I'll just add to that, Kevin, that look, I think every investor would love to just have big quarries with long reserves, right? Make little rocks out of big rocks. Then you start embracing the downstream, and then you get into more of the construction. As a lot of these buyers get bigger, in an attempt to move the needle, because organic growth maybe not just enough for shareholder return, they're going to have to start thinking about some of the downstream, getting into more vertically integrated activities. The markets tend to go that way gradually. We don't see markets reverse trends, right? Where they unwind and go to, I'm just going to do the aggregates piece. So I think that buyers we're seeing it. We're seeing it from some of our typical buyers, a more willingness to look at things 5 years ago they wouldn't have considered. And I think that's out of necessity, because now that they're getting bigger, they need to do more to keep up with growth expectations.
Mm-hmm. Well, guys, we talked mostly about a lot of the fixed, predictable things. Cover the markets and what's happening within those. I guess what other outliers? Rob, you mentioned interest rates and kind of the expectation that those will come down. We've got an election coming up here in November that people are obviously keeping an eye on, and I think there's global events that could potentially have impacts on where the industry goes or doesn't go. What other factors or impacts you think could potentially come into play second half of 24 into 2025 and possibly even beyond?
I'll take a stab at get it started. I think so. Embedded in our IIJA bill is in essence, the highway bill. And reauthorization efforts are going to start in earnest right after the election. We had a really good bill. I know it got eroded with inflation, but it was a really good bill compared to some of the previous bills. I think people are going to be looking at what's going on in Washington to see that was a bipartisan bill. Does bipartisanship still exist when it comes to the infrastructure? I think as people on both the buy and the sell side look at that, that can either create some real enthusiasm or that could create real uncertainty. So I think efforts early on, signs of efforts to reauthorize the highway and infrastructure funding will be something to really watch.
Rob, what do you keep an eye on?
Yeah, I'm not sure I'm foolish enough to take a political stance, but what I'll say is, depending on where you fall, it doesn't really matter. I could find an economist article arguing that the other party would do better with economics, so it doesn't. Making those predictions aren't that aren't that useful. It's just depends on how you see things. I think that there are some differences in tax rate proposals between the two parties, and that might be one of the bigger swings. And again, depending on where you fall there, that might have an effect on how you see businesses performing from a bottom line standpoint, and also where you think money might be generated from as well. I think that there's more global uncertainty with wars right now and such that I certainly hope won't take effect, but it does affect where the government allocates dollars, which can be good or bad. I mean, the infrastructure originally, interstates were made to land airplanes, right? They were supposed to be a military effort. So in some ways that can be great for funding, and other ways it really could be just another bucket to put funding in versus military spending. So I think that for better or for worse, global factors are going to have an effect on things going forward. But the focus right now everyone has is this IIJA coming to the end and looking for reauthorization. And I think that's probably the wisest place to keep attentions.
Yeah, it's really not that far off. I mean, I think it was passed in November of 21. So, I mean, I guess we're looking at 26 as the year when that's gonna really come up, and something's gonna have to happen there. And George, I think you hit on the key word, bipartisanship. There was a lot of talk between 2016 and 2020 of getting infrastructure shored up nationwide, and in the IIJA bill happened in 21 in the current administration because there was just enough bipartisanship. So it seemed like that was the element that allowed it to come together, and I agree. I think that's going to be the factor that either gets another one passed, like a sizable, productive one for everybody passed, or we're just continuing resolutioning this thing along. So, not asking you to comment again, I guess, but yeah, I'm in agreement with you on that.
Yeah.
I think another thing that's sort of an unknown out there is where technology and recycling type efforts are going to go. So they're great, but if you think about it, they will take market share away from some of our traditional sectors. So I think about it in my early years in the career that we didn't even talk about wrap in hot mix. Right now you see mixed designs 30-40% using recycled materials, which means less virgin aggregate, less liquid asphalt on that. You're seeing substitutes for cement. You're going to be seeing substitutes for all the materials if it makes economic sense and if it plays to the recycle and green approach there. So I think that's just something for the industry to adapt to. But and I don't know at what pace it's coming, but that's an unknown in terms of the next few years.
That's one to keep an eye on as well. Well, George, Rob, again, we covered a lot of ground here today. Anything else you want to share? Any other insights?
I think you covered most of our thinking, to be honest, Kevin. I think that's
I think when we started this, sometimes it's what are we comparing where we are to? If you're comparing it to a year where price increases were double digits, earnings increases were 25-30%, and now you're back to some more moderate levels, you think it's not as good. But we're at a really good high level of performance in the sector right now.
No, you're right. Probably even me, for myself, I'll have the tendency to overreact because we're not operating at those highs. We're operating at these more normal, probably what you're describing or characterizing as a normal rate. That's okay.
And I use that manufacturing one, 80 billion to 240 plus minus billion. I may not be getting the same growth rate that I had the last 2-3 years, but I'm at a completely different level of activity that I'm growing off of.
Guys, we'll leave it at that. Appreciate you getting together and look forward to the next opportunity when that comes around.
Thanks, Kelly.
Thanks, Kelly.
Well, that was George Reddin and Rob Mineo again from FMI Capital Advisors. Guys, thanks for joining us. Hard to believe that we're 22 episodes into drilling deeper and we just got you on the podcast, but we'd love to have you back, and we're glad we got you in this time for a really solid mid-year 2024 update on what's happening with the construction materials industry. And Jack, there's kind of a lot to unpack and unload there. You had mentioned toward the top of the episode today, the second quarter reports were coming in as we got together with George and Rob, and it seemed like, as you kind of alluded, a lot of the sentiment about weather, about aggregate pricing and volumes, those stories, those sentiments are very much same between the big public companies, whether that's Vulcan Materials and Martin Marietta or Knife River, CRH, Wholesome, you name it. One thing that kind of gave me pause that I think George stressed and Rob helped support as well, we're constantly as a magazine on top of these volume reports that are coming out from the USGS, and it seems like maybe 5 or 6 quarters in a row now where these volumes have been dipping, and as I put those together for Pit and Quarry, it has just kind of gotten my attention, and it makes me wonder, like, what's happening? I mean, is there something bad happening out there that we're seeing sand and gravel volumes dip 3-4% a quarter, or crushed stone volumes dip by that much or more a quarter? And I think it was George who basically said, we're coming back to more normal periods for construction materials production, because when you think about it, we had some really strong years there, coming into the late 2010s. Those early COVID years were still pretty solid, and while some of the numbers and reports that we see were down on volumes, that pricing narrative that we've been talking about for a while continues. We're not seeing those double-digit price increases that we did several quarters back, but there's still good low to mid single-digit price increasing taking place, and the earnings are still there, the profits are still there. It's not all about volumes anymore. And I think it was in George's and Rob's recent article that we published in September. I think they had a quote from Knife River's Brian Gray talking about, it's really about quality over quantity. And producers at large will tell you, I mean, they don't necessarily have to get more sand and gravel or crushed stone volumes out the door as long as they're getting better value for the material that they're producing. And that was a good reminder to me. Something that George and Rob kind of paused on. And there was a lot more there. I know manufacturing. We talked about that and how that's driving non-residential, and that's an interesting category because it does seem like from year to year, like one different subsector of non-residential can be driven by data centers or warehouses or offices, which isn't really the case right now coming out of COVID. But manufacturing's strong, and all in all, Jack, I guess I would say I feel pretty good about where things are coming out of that interview with those guys. I felt pretty solid, that the industry's in a good place, but it was just affirmation of that for me, hearing from George Reddin and Rob Mineo.
Yeah, 100%. And I think you kind of touched on this a little bit, and I had mentioned it earlier in the episode, is that it really does seem to echo what we were hearing from a lot of the big producers in the second quarter, that, yeah, volume's down, but, there's still a good amount of demand, a good amount of backlog. They're sort of combating those volume decreases with pricing increases. You were talking about residential and non-residential. They also obviously hit on non-building, talking about how there's going to be a big influx of IIJA funding coming in this year. Fingers crossed that's actually the case. I know there's still kind of been a little, depending on where you're at or depending on what you're doing, there's still a little bit of maybe uncertainty with how those funds are being distributed or when they're going to be distributed. So hopefully that's the case, as we're now in year 3 of the IIJA. A lot of good infrastructure money getting out there. The other thing that kind of stuck out to me, and obviously a lot of what we lean on Rob and George for, is their insight and their understanding of the mergers and acquisitions market. And Rob brought up the point that M&A has been pretty heavy on the aggregate and asphalt side of late, and that's obviously exciting news. Anytime that there's able to be a lot of business going on in that front within the industry, it's seems to be, at least from what I understand, seems to be a sign of good health, and that people are willing to buy and invest in different ways. And when companies are sort of divesting to focus more in one area, that's always exciting as well. So yeah, no, it just, like you said, it even with some of the struggles that have been going on, volumes dipping, the weather, all the headwinds that kind of are hitting producers in the face, it still seems to be a very healthy industry, and it seems producers are in a spot where they're kind of saying, bring it on, we're still gonna get the job done. So it seems like we're in a good spot.
Yeah, anybody who wants to hear more about M&A, George, Rob, and Evan Kovlin's perspective on what's happening out there in terms of the environment, the M&A environment, pick up our September issue. We've got their latest column, the headline, Seizing the Moment. They basically characterize the space out there for M&A, as good as it's ever been here in 2024. Buyers are confident, sellers are ready to unload. There's cash on hand, and it seems like based on some developments that we talked about late in that interview, we're going to see further activity, more confidence from buyers to continue to move forward. And I think even since I finished that interview with those guys late this summer. There were some big deals that went down, involving Arcosa and Heidelberg Materials. CRH was making some news. So just again, another reminder that M&A is rampant and it's not going away anytime soon. If anything, it's going to keep on this pace or increase a little bit more. So again, thank you to George and Rob for sharing their insights and look for more of their insights in the magazine. Well, what else can you look for at Pitt and Corey at this point in time? Well, plenty.
There's a lot going on.
There's always something going on. There's no shortage of that. We're late into August as we're dropping this one now, and so hopefully you've picked up your August edition or you've looked at it digitally because that's been made available, and we've got a special section dedicated to washing and classifying equipment and technology within that. So take a look at that if you're looking for shopping around for your next solution. We recently just finished the September edition. We're always working a little bit ahead, and that should be dropping somewhat soon. Again, I mentioned that column, the Market Insights columns in our P&Q business section. So we'll have plenty of content, new content for you in the next month's edition. And our September edition really takes a spotlight to the upcoming Mine Expo International Show. That's September 24th through the 26th. We've got a special pull-out supplement. It's the aggregate guide to Mine Expo. Anybody who's attending that show can take their show copy that they get in the mail or come by the Pitt and Corey booth because we're going to be in the North Hall of the Las Vegas Convention Center. Our booth number is booth 216. So you can use that to see some must-see exhibits that are at the Mine Expo International Show. And Jack, ironically, that was the first probably trade show or trip, I'm guessing, that you ever took for Pitt and Corey. And it was a 2021 show, which is kind of odd because that show was supposed to be in 2020. And here we are again. You just mentioned you celebrated your 3rd anniversary here at the magazine. Congratulations.
Thank you, sir.
But yeah, getting back to Mine Expo and you can engage the magazine. Hopefully our show guy can help you through. Jack provided some good exclusive content that you'll only find in Pitt and Corey, and we've got that must-see exhibits component that can make your show a little bit more efficient. So a lot to look for in the September edition of Pitt and Corey. We also have the Pitt and Corey Roundtable and Conference coming up, so if you want to attend that or want more information, check us out at pittandcoreyroundtable.com. And Jack, I don't know. I think that's about it for the housekeeping duties, unless I'm forgetting anything that you wanted to add.
No, I think I think that's about it. I will give a shameless plug and say that along with Pitt and Corey September wrapping up, Portable Plants September recently wrapped up as well. Got some good content in there. Kevin and I got the chance to go out to a local contractor who's doing some crushing with the oldest Eagle Crusher 1400 turbo plant. The very first one they manufactured. It's had quite a life. It's spent its whole life in Ohio, but it's bounced around a little bit here and there, and it's still running strong. So you're going to want to check that out in Portable Plant September, along with a lot of other good content, a recap of Hillhead, a great story from Phil Perry as he's become a pretty regular contributor on Portable Plants, and we appreciate that. So it's been a very busy July and August for the Pitt and Corey and Portable Plant staff, but we saw it through. We're here having a great time doing Drilling Deeper, and check us out at Mine Expo. Find more info about the Pitt and Corey Roundtable and Conference, and as always, stay tuned to Drilling Deeper. Before we go, I want to give one more thanks to our show sponsor, TCI Manufacturing. Celebrating 25 years of excellence in 2025, TCI Manufacturing embodies the promise of concepts to reality as the industry's leading aggregate resource. TCI specializes in precision-engineered, custom-fabricated steel products, committed to delivering top quality, strength, and precision in every project. Learn more at www.tcimfg.com. And as always, if you want to hear anything from us or anything you want to let us know, shoot us an email. Those are in the description of this episode. So, be sure to let us know if there's anything you want to hear or anything, you don't want to hear, I guess, too.
Well, thanks for listening, everybody. That was episode 22, and we'll see you again in another couple weeks.
See ya.